Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the possibility of lower mortgage rates this summer, given tariffs being blocked, Trump's talk about an implicit guarantee for Fannie and Freddie, and more. First, I want to thank our sponsor, Rocket Close, for making this episode possible. Logan, welcome back to the podcast. You're like a true celebrity now.
The President of the United States shared my article. You know what's weird? I was up, of course, I was up late looking at the bond market, and the bond market trades, a little bit differently lately, late at night. And then all of a sudden I see this like surge in activity, and I was like, so we had an interview with Yahoo this morning, so I had to go to sleep. Then I wake up and then everybody's like telling me the President of the United States shared your article. And I was like, okay, the president approves the chart daddy, chart poppy, brain candy, whatever you want to call it, good to go. So
I don't know if he approved any of those things, but yes, and tell us what the article was.
It was the article was Bill Pulte's calling for the Federal Reserve to lower rates. And again, a lot of people come back and go, well, the Fed cut rates and then, the bond yields went up. No, the 10-year yield got ahead of the Fed rate cuts, and we're pricing in much weaker economic data. We had a 2% move lower in mortgage rates from the peak before any rate cuts happened. So remember, the equilibrium is still 65 to 75% of where the 10-year yield of mortgage rates can range is still Fed policy. So when Fed President Neil Kashkari a few months ago said, listen, if we wanted to have mortgage rates go lower, we can do it. We could cut rates and get a lower rate trends, but we're just not at that stage in our policy. So this is why they do it. I know a lot of people get confused about this, but if you cut rates more, the lower end of the band, you can, 6% would be much easier, which was interesting because we'll talk about this a little bit later. But with the tariff situation might get blocked. The Federal Reserve has already made a comment about that, but a lot to talk about. Man, it's like a whole 3 months happened after our last podcast. We're just having with this event, that event, this event. Oh, so a lot to go.
We talked 2 times yesterday about, okay, we're going to talk about this. And then something else said, we're going to talk about this. And this morning it's like, okay, now there's like 4 topics. So let's dive into the tariff part, because you did like this could have some legs for mortgage rates. So tell us what the latest is and what you think is going to happen.
So before the trade war tap dance, we had 2 rate cuts priced in. I think where I'm different than everyone else, a lot of people say, well, the Fed would have been cutting rates now because the CPI inflation. And I disagree with that. I say that, let's say there was no tariffs, no Godzilla tariffs. The Fed would have been doing what it's normally done. We're going to take our time. The labor market is still sound. Jobless claims are still low. We're getting close to neutral policy. Maybe we don't need to. They would have frustrated us anyway, even if there were no Godzilla tariffs. What Godzilla tariffs did is that the market obviously we could see now the stock market doesn't like tariffs, right? So that's just the same thing in 2018, 19, and the same thing now. So market activity pushed the 10-year yield below 4%. So what we talked about almost 3 months ago is that I don't believe the 10-year yield should be here based on the labor data, based on Fed policy. So we should be around 435 to 470 is an acceptable range. If the data gets weaker, then yeah, you could take it all the way down even to the borderline, but we're just quite not there yet. And again, I'm working off of Fed policy. That's what I don't make the rules. It's them. So my job as an analyst is just basically conform whatever my models believe that we could range in. But now I don't, there might be other ways that the president and the White House can get tariffs in, but obviously that was a blow. I even think one of the judges were a Trump appointed judge too. So in any case, what this does is, what does this mean for the Federal Reserve now? Because they made we're waiting because of tariffs. That was their whole policy, that, we raised our inflation expectation because of tariffs. We raised our possibility of a recession due to tariffs. Now what do they do?
What do they do? Okay, so what did we had a Fed president come out today? What did they say?
Yes, President Goolsbee from the Chicago Fed said, if you do deals, we could lower monetary policy. So there's your first a shot out there. Of course, it makes their job a lot easier if there were no Godzilla tariffs. Of course, the stagflation discussion and everything in that nature starts to fade away. So, um, Fed presidents, okay, their verbiage now becomes even more critical because now they can say, well, if Godzilla tariffs aren't here, or if they do trade deals, then if they all start to talk about this, just kind of think about the 2 rate cuts can happen this year in that light, because they only raised their inflation expectations because of tariffs, right? And then Godzilla tariffs just made it worse, and we're back and forth, this deal that, and now legal. So we're in like limbo chaos even more. But you had your first Fed president talk about, well, we can lower monetary policy if there are deals with tariffs.
And would that lowering, would that the two combined be half a point?
I think the market is always priced in 2 rate cuts. So the bond traders are going off of, what economic data is and inflation expectations. You remember, the Fed raised their inflation expectations knowing that tariffs might be the policy. Nobody expected Godzilla tariffs. So that kind of threw everyone, through the markets array, through the bond market, everyone. So everyone's trying to adjust to what is going on. But kind of before the legal court case ruling, people are saying, well, we might not cut rates at all until September, until we see what's going on. But now we have deals starting to be done. Now we block it. So we need a little bit more clarity. Who it's Thursday morning. Who knows what will happen by Friday morning? I mean, it's just we've had so much happen within like a 5-day period. It's crazy.
No, it is crazy. Also, last year around the time that we saw rates drop was that end of summer, beginning of September kind of thing. And I wonder if by, we've all said in the summer is when you're going to start to see some of that economic data, the hard data turn. So maybe we're looking at a late summer rally for home sales.
Here's one thing. If you look at the revenue collection, the tariffs haven't been fully like going into our economy yet. We're collecting more money, of course, but you could see that we're just quite haven't got uh, um, the goods being delivered where it could actually show up on prices. So that's one thing. And this is the thing: tariffs aren't as fast as something like rates, right? So it's a process. So trust me, I know nobody's going to do this track tariff revenue percentage, coming in and to get to see like how much volumes and what percentage. So it's going to take a little bit more time. But again, we're dealing with this deal, that deal, this legal case. So it gets a little bit more hectic and not so simple to maybe track until we get more clarity on what's happening. So again, we just got more chaos to a degree, but maybe there is an end game where the Federal Reserve can actually chime in all of them and then maybe take something forward out there.
Okay, we have yet another variable here, and that is that Trump announced, was it Tuesday? I don't even remember at this point, that there would be, that he was focused on taking Fannie and Freddie out of conservatorship, but said that he would do it with an implicit guarantee. So, we've been talking the last couple of weeks, ever since he said something about taking them out, had different things. The difference here was that he talked about an implicit guarantee. So you wrote a great article talking about what the difference is between implicit and explicit. So let's talk about
There
that.
was, right away, I could already see there was some confusion because they thought that the government backstop would be there, in an explicit fashion. And he tactically used the word implicit. Um, to me, I mean, I applauded that because the worst case scenario that I thought could happen was removed. That you try to take them public without any implicit or explicit backing, which I never, I never thought, like, how's that possible? There's just no way. These are just there's like no, and that's been the stance I've had for many years. We've talked about this. There's just no way you could take them out without the government
Right.
backing. We even talked about this months ago that they ran some models out there, and to me, it looks like they can't do this without giving some type of government guarantee. So the implicit isn't as solid legally as an explicit guarantee where all investors know that's it. We're good. We got the backing out there. So now, at least, if they're using that, they could go to investors and say, "What do you guys think? Where's uh, the spreads you think is going to happen with this. So there's a little bit more clarity on what the game plan is, and with a little bit more clarity, they can go to investors and see what are you guys thinking about this. So I got asked one question: what was the highest spreads in history? And I said May 8th, 1980. It was 5.82%.
Woo!
I think that's correct. I think that's a high where you're basically near 6%. Of course, recession, inflation, there's tons of things happening back then. And clearly, without the spreads getting better, in 2024 and 2025, we would have a much different housing discussion. So it's a little bit more positive in the sense that we gave the government backing, not explicit, but implicit, and then we could go to investors and see what they say. Because the Senate said that, listen, if this is going to raise mortgage rates, we're not going to do it. You could see why now. The president wants lower rates. The Treasury wants lower 10-year yields. Pulte wants lower mortgage rates out here. And in this regard, I think they would even feel a little bit more hesitant if something made things worse in this environment, right? Maybe 2 years down the line when rates are a little bit lower, they can maybe go into this. But now you could kind of see there's something in the background working here.
Okay, so maybe talk for when you say implicit, that's what we had before the great financial crisis, right? That's why they were able to take them into conservatorship. Maybe explain a little bit about the difference there.
So implicit means I'm just going to keep it very simple. If all hell breaks loose, the government will take them. And that's what happened. All hell broke loose and the government take them. Now, we've had implicit guarantees for a very long time. The market was somewhat functioning. If you look at mortgage spreads throughout history, but a lot of things changed after 2008. When you took them in conservatorship and the mortgage-backed security market was broken, the Federal Reserve became the biggest investor into that. So a lot of people said, well, if the Fed isn't buying, nobody's going to buy MBS and the spreads will never get good. Or, so I would say a lot of the higher rates going to 8 to 10, even 12% people were higher spreads getting worse in 2024 or 2025, not getting better. There was only a few of us that I could remember that were talking about spreads should get better because we had an implicit guarantee. We didn't have the Federal Reserve buying mortgage-backed securities, and it always got better as the market volatility stopped, and then the Fed started cutting rates, and that was the premise for the spreads getting better in 2024 and 25. Of course, we had market drama and the spreads got worse a little bit, but now it's improving. A really good example yesterday when the 10-year yield was up a little bit, hardly any damage to rates because the spreads got better there. So we're kind of in a more kind of calm down, secure spot. You do need the 10-year yield to go lower for that next stage for lower rates, but here we are. We got a lot more questions answered and then a lot more chaos happening this week as well.
I think, the reason I wanted to point that out is because, like, the MBA, when it talks about Mortgage Bankers Association, when it talks about, the plan if there is a plan to to release the GSEs, they're calling for that explicit guarantee, right? An explicit federal backstop. And so I think it's very interesting because, to your point, it's if you take them out, the whole thing comes down to what do investors feel safe about? And that's what's going to help or hurt the market.
Yeah, and we also had a marketplace, a functioning marketplace with an implicit guarantee. But when all hell breaks loose, see, that's my thing. When all hell breaks loose, nobody thought Freddie and Fannie would need conservatorship. They just thought they were giants, but their capital leverage ratios are so big, that they need to raise so much money out there. So per the laws, really, so it becomes a questionable theory. Should a publicly traded or even a company be allowed to have preferred shares with an implicit backing? And that's used to be the case. So at least, the worst case scenario in my book is kind of off, where they just take them public and there's no government backing and it's just like mortgage. Like, no, nobody's gonna insure that at normal rate risk.
Love that. Thank you for walking us through that. Okay, more economic news. So less political news, more economic news. Unless you want to.
No. I think this is one of the strangest housing years for people out there. I mean, people are just deer in the headlights with some of these data lines. So let's just review right now. The pending home sales came in If you look at the headline, the biggest month-to-month decline since 2022. What do we always say? We believe the NAR's pending home sales data is a little bit too extreme on the month-to-month Brits. Last month, it was a really big beat. This month was a big miss. Not much is going on. So we want to track our forward-looking data. Our forward pending sales data has finally showed some year-over-year growth. Purchase application, this is like crazy to say this. This is true. Purchase application data yesterday up 18% year over year. For the last 4 weeks, it's been up double digits. It has had a 17-week winning streak. There's less cash buyers this year, of course, but our pending sales are now finally going positive. Our purchase application data is still positive. This is all with elevated rates. If mortgage rates were at 6%, I really would have made a big deal about this. This is all happening with elevated rates. So when I did the interview with Yahoo this morning, I said, positive story, inventory's up, price growth is slowing down. You don't see a collapse in purchase application demand or home sale demand anymore. We're building that base. We show those charts going back to the 1968. What happens every single time? There was not a time that this does not occur. You build a base. The next stage is actually a recession. Sales growth. It's 1968. Right. You take every single cycle. That's why we like to show those charts in that matter. Here, nobody knows what to do with this because they're like looking at this data and they're like, oh, that's like 4 straight weeks of double-digit year-over-year growth. Remember, purchase apps look out 30 to 90 days. So did a little mini dissertation on this on X to try to teach people. But what if you get these applications, but it takes longer to sell a home? It doesn't mean they fall into the monthly data prints right away. So in 2020, this is a perfect example. In 2022, the 10-year yield went lower at the end of the year. We had 12 weeks of positive forward-looking data and purchase apps. It all fell in one report. It was like 500,000 more home sales. Nobody really had that, but it all just fell in there. Even though there was 12 weeks of data that was getting better, sales didn't, weren't grow. And all of a sudden, one report, kaboom. Even I said, that was it, guys. That's everything fell into one report. It's really crazy. So kind of look at it in that light. But, and this is key, the existing home sales reports that you will get in July to November for the months of June to October will have the lowest comp prints in history. So if you see year over year growth, because if I take the last existing home sales trends and just have it be flat, in 2 months from now, it'll show positive year over year growth. And this is happening with elevated rates. If mortgage rates could get down to 6%, as I talked about in Yahoo, we could get more sales. We just see better tracking data with that. So as crazy as it is, I love 2025. I mean, I'm getting my inventory growth. We're almost back to 2019 levels. We're at the low end. So it's kind of like, I had to explain this to somebody. Somebody said, oh, we're at 2019 levels. No, we are at the seasonal peak periods of inventory, which is touching the bottom end of 2019. What we want to do is start a year at 1.52 million. Now, a lot of people would say that's still historic low. Yes, it is. But you're never going to hear me say the word low inventory once inventory is above 1.52. I've been saying this for many, many years, that this has to happen. You want a functioning housing market, you got to get this to happen. So I'm loving seeing all this. We're doing all this, and there's no national home price crash. All these 2006, by the way. It's hilarious how the doomers are very good in taking one single data line and say, this happened in 2006.
Right.
This happened, and I was just like, no, that was a different marketplace. But in this case, I think the purchase application data confused people. Also, the new home sales purchase application data is a post and pre-COVID high. And everyone's like, what? So Sarah, you and I have had this talk for 4 or 5 years now.
Yep.
This data line is very funky. And unless you religiously track it, it could confuse the hell out of you. And this year, it's confusing the hell out of everybody. But we could see some growth for during that period. Remember, in July to November, the reports were June 8th, just because we have a very low bar, and take it from that kind of grain of salt on the pending home sales data, both positive and negative, unless the forward-looking data that we track kind of confirm it. So in short, not too much is happening, but the fact that it's a little bit healthier market with elevated rates just show that what President Trump and Bessent and Pulte want, lower mortgage rates. Why? Because younger people finance most of their home purchases. and they benefit the most when, in fact, the millennials actually took back the number one ranking 2 years ago when rates fell a little bit and they're
That's
back
right.
up there. They're massive, right? Just a massive. It's like 50 million of them working. There's only 17 million baby boomers left working. Gen Z has actually surpassed the baby boomers in terms of workforce. So you can understand why that's been the case. But if you're totally confused with housing data, I totally get it
You just
because
totally you just totally skipped by Gen X. What is that?
no, I said Gen X is fine. They've been very stable the entire time. It's funny because I mentioned that, the person thought I was talking about Gen X being the biggest. No, Gen X has a very healthy, firm percentage because they would technically be the move-up buyers. Now, again, if you're a mortgage rate lockdown person, you're basically saying we're going to miss about 2 to 2.5 million home sales because the Gen X and baby boomers will never buy because they're locked in. They're locked into their house. They cannot do anything. Inventory cannot grow ever. They're locked. And guess what happened? Every week, every month, people sell their low mortgages, buy. Life happens. See, the mortgage rate lockdown is a really doomsday theory. It is really like,
because and we had a whole debate about this, which we won't go into here, but
you don't want to go into it because you lost.
It's really your definition of mortgage rate lockdown. Nobody else thinks about it the way that you do.
Oh, and a lot of people think about it. They always tell me inventory can grow. Nobody's going to sell their house with their low mortgage rate. Every day I've been hearing that and go, that's not in the data. Now, granted, most people don't have the coupon data to take a look at to see that this has been happening for years, but it's okay. That's why I'm here. So we should know, one of our debates or further ones, we should have another mortgage rate lockdown debate because I got a whole mess of more data lines to show now. Sarah Wheeler. And guys, thank you. Thank all the people out there for understanding how bossy you are, because I had my hair wet and everything, and you're looking at me like nodding your head. I ain't gonna happen. Go fix your hair up. Shut this down, E. We're gonna wait until he gets his hair fixed and then start over again.
Logan,
you are bossy, and we have evidence of it now.
Logan, you are the Ferris Bueller of economics. You really are. Like, you convince people that somehow you are the poor person that's being persecuted here, and I'm like a Jennifer Grey's character, his little sister. I'm like the older sister. That's how I always feel. You always people are like chiming in how I'm being so mean to you, you're so bossy, and I'm like, are you kidding me? Pretty soon
Sarah,
I'm gonna look out
Sarah,
and there's gonna be a Ferris Bueller thing.
We have it on video recording. So there's nothing you can't hide from this. Your face,
I was shaking my head.
Your face was just doing, no, this is not happening, Chart Poppy. Go fix your hair up. No, Clay, take all this off this, fix everything up. And we go straight. All of a sudden my hair's all wet. And then all of a sudden 2 seconds later, it's like, Pat Riley again.
This is my job. I was doing my job. I appreciate your wrap up of this housing market because it is really confusing and it's kind of hard to know, like, is this positive? Is this negative? Because we have so many variables and we have so many different data points coming out. So I appreciate you kind of walking through and saying, like, this is how you feel about this housing market and what our short-term prospects are.
I've always stayed consistent with my work. I was like, again, this started in May of 2020. We were looking back at the Twitter like, oh my God, home prices are up 8%. Guys, this is not a good spot to be in. Inventory's breaking. The unhealthy housing market was prices escalating out of control because it kills future demand. The healthy housing market is inventory is growing, more choices, price growth cools down, wages and households can catch up. And then when rates go lower, every single cycle since 1968 of existing home sales, right? So if home prices were up 6-7%, inventory wasn't growing and new listings data wasn't growing, I would not be saying this, but that has not been the case in 2024 and 2025. 2024 home prices was a little bit hotter than I would like, but it wasn't egregious. And this year, I still need a more softness in the second half of the year to get my price forecast correct. But all of this is good. It sets up a better backdrop for the future, where in 2023 wasn't the case. Prices fell, ended up 6%. Home sales were record low levels. New listings data didn't grow. Inventory only picked up very late in the second half of the year. This is different. This is better. And it gets a better foundation for growth in the future for whenever rates do fall down. And again, you don't need 3, you don't need 4, You don't need 5. I mean, all that would work, but just getting down to 6 and getting going.
We can hope for that. We just down to 6 would make a huge difference. Logan, thank you so much. We will talk again very soon, and that's good because things change fast.
Salute. God bless America.